Hi guys, I hope you are all good. Welcome to another lesson, and today I'm going to talk to you about the central bank dealers range and how you can potentially take advantage of it. Now, just for reference, the central bank dealers range is just something we are going to utilize for an extra piece of confluence. It is not solely to be utilized based on entries within the market. You can sometimes get entries without using the central bank dealers range. And a lot of the time, you might not even decide to use the central bank dealers range. This is just another piece of the puzzle which you can add to your skill set, and you can be very aware of it when you see the whole thing play out. So the central bank dealers range is a range of price action which the algorithm essentially refers to. If you go back to the last lesson where we spoke about timings, session timings, the algorithm refers to all of those specific times. But the central bank dealers range is a specific time period of price action which you're going to box together and you're going to utilize to try and understand what the purpose of it is going to be, and essentially try and work out a potential bias for the day. I say potential because it doesn't work every day. There are conditions to be met to give us a valid dealer's range. That's very, very important. Okay, you need to have specific rules in place before you even consider utilizing the central bank dealer's range. And we're basically trying to use this to aid with finding the high or the low of the day. The time period is utilized between 7 p.m. and 1 a.m. UK time. Okay, 7 p.m. and 1 a.m. UK time. I've got the New York Times on there as well. Obviously, if you're in a different time zone, you're going to need to change that to suit your particular time zone. You're looking for the high and the low, and I'm going to show you what I mean, but you're looking between the high and the low of the range that has been created between the hours of 7 p.m, 1 a.m. UK time to be between 20 and 30 pips, certainly no more than 40 pips, and no more than, should be 10 pips, not 100 pips. Okay, so no less than 10 pips. The range needs to be calculated between the high and the low of the range, as just mentioned. This must be used in conjunction with market structure. As I mentioned, this is just an extra piece of confluence which is going to help you with your trade setup and help aid the high or potential high or low of the day. Now, before I go onto a chart and show you an example of how this can work, I want to talk about standard deviations. Now, a standard deviation here is where you're going to utilize the center point of, or you're going to utilize the range of the central bank dealers range. So this here is going to be your range between, and if we go back, between the hours of 7 p.m. and 1 a.m. And you're going to need it to be between 20 and 30 pips and no more than 40 pips. Basically, if it's any more than 40 pips, which you see here, that's usually because there's some high impact news event, and that's going to make the London session especially very, very unfruitful to trade. And we want the high or low of the day to actually come in the London session in an ideal world. But let's say and again, I'm going to show you an example, but let's say just for this purpose, we are utilizing the central bank dealers range. We've got all the conditions that are actually in place. We're going to utilize standard deviations to help us aid with high or low of the day. So ideal buy days and sell days will create a high or low around 1 or 2 standard deviations. So basically, if price action was to rise and start turning around this 2 standard deviation phase right here, and then reversing and creating a sell model that happened within 2 standard deviations of the central bank dealers range, that is going to give you an indication by utilizing the central bank dealers range that has created the high of the day and sells are now valid in price action. Vice versa, if we're looking for buys, you want the central bank dealers range to to form, and then you want price to come lower around about the 2 standard deviation mark, where you can potentially see price reverse and give you a buy model to push price higher, either in the London session or in the New York session. It absolutely can work around 3 standard deviations, and I have taken many entries before around 3 standard deviations. I've taken it around 1 standard deviation. If anything pokes around the 4 standard deviation, that's usually because there's going to be some sort of high impact news event which you just need to take note of. So you should definitely look to avoid it, as we're obviously saying here. So if price was around 4 standard deviations, I wouldn't really pay much attention to it. And if it exceeded beyond 4 standard deviations of this price action, then I would definitely not get involved in the price action, because it could be an NFP or something like that. So, as mentioned previously, the idea of the central bank dealers range and the standard deviation is to use this as an extra piece of confluence when price reaches a point of interest area. So if you've got price on a sell situation reaching a high of the day and it hits 2 standard deviations, but within the 2 standard deviations you're inside maybe a 4-hour point of interest or a 1-hour point of interest area, that is going to give you an extra piece of confidence that the central bank dealers range and your standard deviations are all going to come into play nicely. So, as mentioned, you don't want price action to be any more, well, you want it to be between 20 and 30 pips. You don't want it to be any less than 10 pips. We're very much on the cuff here, but this is acceptable to utilize. Okay, so 12 pips is this price action. And as you can see, this is between the hours that we have specified. If we just go all the way back, it's between 7 p.m. and 1 a.m. UK time. So 7 p.m., 1 a.m. UK time, we've marked out the high or the low, and we've measured this range, which is 12 pips. I have brought a box, I've got a box, and I've measured the same area. So it's like copy and paste in that box, bring in one below, which gives you 1 standard deviation, which is what I'm talking about when I say 1 standard deviation, 2 standard deviations. We're copy and pasting essentially the box between the high and the low, and we're dragging it 1 above, we're dragging it 1 below. And you are going to see live examples of this in future lessons, so don't panic. As you can see, it's coming into an area of interest, which I'm going to show you on another slide, but this is just showing you an example of the central bank dealers range forming. You can see here price has come literally to the line, to the bottom of the 1 standard deviation, and started pushing to the upside. Once we've done that, from an area of consolidation, we've had manipulation, and then we've had distribution. We've had price pushing higher. This is your expansion. As you can see, price retraced and then gave us a push to the upside again. So this is just showing you the power of what standard deviations do. Now, this isn't going to be the case every single day, and you need to make sure all of your confirmations are there, basically. So we mentioned earlier that we want price to be within a higher time frame point of interest area. And as you can see, this 1 standard deviation area has brung price to this particular low. That has created a low of the day in the London session, but it is also mitigated into this 1 hour order block. It's actually an FU candle as well, because we swept under this particular low here, calling that an FU candle, as well as mitigating into the rest of this imbalance. And as you can see, price gave us a nice change in the state of delivery, because this order block, which was created on the 1 hour, was engulfed by this blue candle, which is now creating a change in the state of delivery and confirming this is a valid 1 hour order block. Price never made it right back down to here, but it did come back down to retest the top wick of the candle that has been created, and then it pushed to the upside, creating the central bank dealers range, and then came to make a low of 1 standard deviation within the central bank dealers range, mitigating perfectly into the order block which was created, only to see price expand higher, creating relative equal highs, helping us with a target, utilizing this fair value gap to take price to the upside even higher. So you could have been a part of it down here all the way up to here. I'm going to show you an example of that in a second. But we're going back to that old thing again. Area of interest, fair value gap, expansion. But this time we're adding the central bank dealers range as well. So as you can see, price on the smaller on the 1 hour time frame created a huge expansion to the upside. Now there's multiple things going on in here which I haven't marked out, but I'm going to explain to you, because you have to get used to looking at these things in real-time price action, and they're not going to be marked out for you all the time. As you can see, price action hit this 1 hour order block, expanded to the upside, created this 1 hour fair value gap. Price not only came back to the OTE level, which is your 71%, it mitigated into this area of imbalance, this inverse area of imbalance, which if you refer back to the higher time frame levels video, this is a balanced price range after hitting a 1 hour order block. And we have the added confirmation, 2 added pieces of confirmation here. Well, 3. 1, it's the New York session. 2, we're in an OTE area within our balanced price range. And 3, we've now utilized the central bank dealers range, and we're within 1 standard deviation. It is absolutely more probable to be between 20 and 30 pips. We would love it to be 2 standard deviations, but this is price action which wasn't as volatile on the day. This is just showing you that what the algorithm does. Okay. Now, once again, you can see this is your entry on the 1 hour that was here. This grey box is the entry on the 1 hour. But when price mitigates into what was this balanced price range on the 1 hour time frame, on the smaller time frame, we get another expansion to the upside, creating another, well, we create 2 fair value gaps. And if you go to the 1 hour time frame, there's the imbalance on the 1 hour, and there's another area of imbalance. So that is an inverse imbalance. So within the 1 hour time frame, we have created another balanced price range. You could enter on this wick on the 1 hour time frame without looking at any of the noise below. And we have this down candle, which is engulfed hugely to the point where it even engulfs this candle on the 1 hour as well. That is a massive change in the state of delivery. We've got another valid order block, and this is a proportionary order block because this order block has also mitigated into these candles as well. And in actual fact, this is a proportionary order block as well, because you have this original 1 hour order block right here, which was the higher time frame point of interest. And a proportionary order block is another order block mitigating into a current order block and then creating and turning itself into another order block. Hopefully this is starting to make sense. So a proportionary order block, which is this one here, is basically the second order block. So you've got this order block which is being created with this change in the state of delivery. Price action comes, creates this down candle, mitigates into this order block. Price engulfs it higher, creating another order block. This is a proportionary order block as well, as is this one, which came into these candles. It didn't come quite down to this area here, but it is another order block. And as you can see, we had balanced price range with here and here, and we have this order block, this fair value gap here, which turned into an inverse with this huge change in state of delivery. And we had another fair value gap, which you could have got involved in. If we just go to the smaller time frame again, just to get more of a precise of an entry, we measure the entirety of this range, and it's created just a fair value gap. It's not created a balanced price range. We have on the 1 hour, but on the 15-minute, this is the change in state of delivery. And because price is fractal, if you zoom into this area here, that order block was engulfed there. So this down candle was engulfed by this blue candle, which classes that as an order block. So there's your 15-minute order block. You measure the range. It's bang on 88.6%. It didn't quite come down to that level. It came down to the 71% again, but also mitigating this area of imbalance. And what creates a high probable order block, whether you look somewhere in here, whether you look here, and whether you look here? The thing that creates a high probable order block is an area of imbalance after it. Okay, so when you see down candle, engulfing candle, imbalance, price expanding, that order block is high in probability. Now, it didn't come all the way down, but it didn't need to. It just came into this area of imbalance. This is a high probability breaker block as well. If you need help on breaker blocks, go back to the lessons. Price comes into this breaker block, into this area of imbalance, expands to the upside, creating another order block as well. So this was just a lesson on, well, it was a lesson on central bank dealers range, standard deviations, but we've covered multiple things within here. Okay, we've covered proportionary order blocks. We've covered the OTE level. We've covered more on the balanced price ranges. We've covered fair value gap entries. Okay, so an array of entries have been delivered within here, which we could have taken advantage of. And you're utilizing the standard deviations from the central bank dealers range as another piece of confirmation. So we're going to move it on, and we're going to talk about the next thing we're going to talk about in the next lesson. But hopefully you've found this insightful. We are going to go more and more into detail on these central bank dealers ranges in the future. But for now, if I could give you any homework, I would say, and this is the homework, any day that you see news events which are not NFP or FOMC or CPI, I want you to measure the central bank dealers range, and I want you to just do a bit of homework on the pair you want to trade. Usually Forex pairs. This is better on. I should have said that, to be honest. Forex pairs it's best on. Okay, not so much futures, but Forex pairs. This is really good for. I want you to look for this. I want you to do a bit of back testing and see what you can come up with. This does work on futures, by the way, and it's just we use it slightly differently. But again, I'm going to go over that in future lessons. I hope you found this insightful, and I will see you on the next one, guys.